Most people believe they can beat the market. They see stories on the news about someone who picked the next great technology stock. They read magazines filled with tips on how to find undervalued companies. Financial television networks parade experts who confidently predict where the market is headed next. This idea is incredibly powerful. It feels intuitive and empowering. It suggests that with enough research, cleverness, or the right advice, anyone can outsmart the collective wisdom of millions of investors. It is a compelling narrative, but for most people, it is a costly myth. This essay will challenge that common belief. We will start with this very myth, the idea of outperformance, and explain why it holds such a strong grip on our imagination. Then, we will systematically dismantle it. We will not use complex financial jargon or impenetrable formulas. Instead, we will use simple logic, clear evidence, and straightforward examples. Here is the central claim in a single, unambiguous sentence. The single biggest reason most investors fail to achieve market-like returns is their own behavior. It is not a lack of intelligence. It is not a lack of access to information. It is the very human tendency to act at precisely the wrong times for precisely the wrong reasons. Investors are their own worst enemies. They allow emotions like fear and greed to dictate their decisions. They chase past performance, piling into investments that have already had their big run. They pay too much in fees and trade too often, letting small costs compound into massive shortfalls over time. Let us look at the evidence that supports this claim. Studies from firms like Dalbar have consistently shown a large gap between fund returns and investor returns. For example, the S&P 500 index might generate an average annual return of, say, 10%. The average equity fund investor, however, might only earn 7% or 8%. The mantra of buy low, sell high is perhaps the most famous piece of investment advice. It is simple, logical, and sounds incredibly easy to follow. In practice, however, it is nearly impossible to execute consistently. The reason is that our human emotions are wired to do the exact opposite. When markets are plunging, headlines are screaming about a crisis, every instinct tells us to flee to safety. The fear of losing even more money becomes overwhelming, prompting us to sell when prices are low. This is the moment of maximum pessimism, which is ironically often the point of maximum opportunity. Conversely, when markets are soaring, everyone around you is talking about their investment gains. Greed and the fear of missing out become powerful motivators. It feels safe and smart to invest when prices are high and rising. This leads investors to pile in near the market's peak just before a potential correction. This emotional cycle ensures that the average person systematically buys high and sells low. A perfect recipe for underperformance. In the world of investing, there are forces you can't control: the daily gyrations of the market, geopolitical events, or the next disruptive technology. But there is one critical factor entirely within your command, a factor that can determine the difference between a comfortable retirement and a significant shortfall. We're talking about costs, and among these, fees are the silent killer of investment returns. They are often presented as small, almost trivial percentages, which makes them seem harmless. They are buried deep within prospectuses and account statements, designed to be overlooked. A 1% management fee, or a 1.5% expense ratio. Psychologically, these numbers feel insignificant in the short term. We might dismiss them as the small cost of doing business, a minor toll for professional management. But this is a dangerous misconception. The corrosive power of these seemingly small costs over a long investment horizon is staggering. To truly understand their impact, you must first recognize that not all fees are created equal. They come in many forms, each chipping away at your wealth in a slightly different way. The most common is the expense ratio. This is an annual fee charged by mutual funds and exchange-traded funds, or ETFs, as a percentage of your investment. It covers the fund's operating expenses, including portfolio management, administration, and marketing. Then there are trading costs. These are incurred by the fund when it buys and sells securities. They aren't included in the expense ratio, but are a very real cost passed on to you, the investor, which can reduce your returns. Funds that trade frequently will have higher hidden trading costs. Some funds also charge sales loads, which are essentially commissions. A front-end load is paid when you buy shares, and a back-end load is paid when you sell them. These can take a significant bite out of your principal right from the start, or penalize you for exiting an investment. Finally, you might encounter account fees, charged by the brokerage firm for maintaining your account. These can include annual fees, transfer fees, or even inactivity fees. While often small, they add another layer to the total cost of investing. The critical point is this: fees are not a one-time charge. They are deducted from your assets year after year after year. This isn't just a simple subtraction. You don't just lose the fee itself, you lose all the future growth that money could have generated. This creates a relentless drag that compounds against you. While your investments are working to compound in your favor, fees are working just as hard, compounding in the opposite direction, directly and profoundly reducing the final amount of wealth you will accumulate for retirement, your children's education, or other long-term goals. It's a hurdle that your investments must clear every single year before you even begin to see a real profit. Let's illustrate this with a simple, clear example to make the abstract tangible. Imagine two investors starting on the exact same day with the exact same ambition. First, we have Anna. Anna starts her investment journey with a lump sum of $100,000. And here we have Ben. Ben also starts with an identical $100,000. Both invest for a long-term horizon of 30 years. For the sake of our example, let's assume both of their chosen investments earn a hypothetical 7% average annual return before any fees are considered. Their paths start identically, but their choices about cost will lead them to vastly different destinations. Anna is a cost-conscious investor. She does her research and chooses to invest in a low-cost, broad-market index fund. The fund has a very lean expense ratio of just 0.10% per year. Ben, on the other hand, is persuaded by a pitch for an actively managed fund that promises to beat the market. This fund comes with a higher expense ratio of 1.10%. The difference is just one single percentage point. It sounds small, almost negligible. But let's fast forward 30 years and see the consequences of this one small choice. At the end of the 30-year period, Anna's investment, benefiting from its low-cost structure, would have grown to approximately $710,000. Her net return, after that tiny 0.10% fee, was 6.9% per year. Now let's look at Ben. His investment, eroded year after year by that seemingly small higher fee, would only be worth about $550,000. His net return, after the 1.10% fee, was only 5.9% per year. Let that sink in. That 1% difference in fees cost Ben $160,000. That's more than the entire amount he started with. It's a new car, it's a down payment on a house, it's years of comfortable retirement living, vanished into the ether of fees. And remember, this assumes his actively managed fund even managed to match the market return before fees, which is statistically not a likely outcome over such a long period. If the fund underperformed, the gap would be even wider. Ben didn't just pay a higher fee, he paid an enormous opportunity cost. The $160,000 he lost wasn't just taken from him, it was prevented from ever growing and compounding on his behalf. This is the true, devastating power of investment costs, and the most compelling reason to make minimizing them your absolute priority. In many areas of life, activity and effort are directly correlated with success. The harder you work, the better the results. In investing, the opposite is often true. A flurry of activity, frequent buying and selling, is a reliable path to lower returns. Many investors feel the need to, do something when markets move or headlines flash. This impulse to act is tremendously counterproductive. Every trade comes with costs, both explicit and hidden. Explicit costs, brokerage commissions. Explicit costs, the bid-ask spread. Hidden costs, slippage and implicit fees. These may seem like pennies, but they add up and erode returns. An active trader can see transaction costs shave a meaningful fraction off annual returns. For day traders, those costs can be insurmountable. Frequent trading in taxable accounts can trigger higher short-term capital gains taxes. Overtrading also magnifies behavioral errors. Constantly reacting to headlines leads to emotional decisions, selling in a panic, buying into speculative frenzies. That churn stops you from benefiting from long-term compounding. Academic studies back this up. More trading, worse performance. If individual investors so often fall short due to behavioral biases and the friction of costs, it's natural to look for a better way. A common assumption is that professional active fund managers, the so-called smart money, must surely fare much better. We picture them in gleaming high-rise offices, surrounded by an arsenal of Bloomberg terminals, armed with advanced degrees and proprietary algorithms. They are highly compensated, have access to vast resources, and dedicate their entire careers to the singular goal of analyzing markets and outsmarting the collective wisdom of the crowd. The allure is powerful, entrusting your capital to a seasoned expert who can navigate the complexities of the financial world on your behalf. Yet, The persistent and often uncomfortable reality is that the vast majority of these active fund managers consistently fail to beat their benchmarks, especially after their fees are taken into account. This isn't an opinion or a fringe theory, it's a well-documented statistical fact, confirmed year after year. The most comprehensive evidence comes from the S&P Indices versus Active Scorecards, or SPIVA reports. These reports are published semi-annually and are considered the de facto scorekeeper in the active versus passive debate. Their findings are staggering. For example, over the 15-year period ending in 2023, a remarkable 93% of all U.S. large-cap active funds underperformed their benchmark, the S&P 500. This pattern holds true across different time horizons, geographic regions, and asset classes. The longer the time frame, the worse the results for active managers tend to be. The data paints a clear picture. The promise of outperformance is rarely delivered. So, why does this happen? The reasons, ironically, mirror the very problems that plague individual investors, but they are magnified to an institutional scale. The first and most significant hurdle is costs. An active fund is a business, and it has substantial overhead. This includes the multi-million-dollar salaries for the star manager and their team of analysts. It includes extensive research expenses such as subscriptions to data services, expert network calls, and on-the-ground due diligence. It includes large marketing and distribution budgets to attract new investors. And it includes all the operational costs of running a complex financial firm, from compliance and legal to technology infrastructure. All of these expenses are passed on to investors in the form of an expense ratio. Even a seemingly small fee of 1% or 1.5% creates a formidable, permanent handicap. Before the investor sees a single dollar of return, the fund manager must first generate enough outperformance just to cover these costs. If the market returns 8% in a year, a fund with a 1.5% fee needs to generate a gross return of 9.5% just to match the market's performance for its investors. They are starting the race several yards behind the starting line every single year. This constant drag of costs is a relentless mathematical headwind that is incredibly difficult to overcome long-term. Second, institutional pressures force harmful short-term behaviors. While investors should ideally have a multi-year time horizon, many professional managers are judged on their quarterly or even monthly performance. If a fund underperforms for a few consecutive quarters, it risks massive outflows of capital from clients and negative attention from consultants and the financial media. This intense pressure creates a powerful incentive for window dressing, where managers sell their losing positions and buy recent winners right before the end of a reporting period to make their portfolio look more impressive. More damagingly, it can force them to sell a promising long-term investment prematurely just to lock in a short-term gain and boost the current year's numbers. Conversely, they might hold on to a losing stock longer than they should, hoping for a quick rebound to avoid reporting a loss, a behavior known as the disposition effect. This focus on short-term optics is often directly at odds with the patient, long-term strategy required for successful investing. They are forced to play a short game, even when the real rewards are won in the long game. Third, the problem of scale. Ironically, success can be an active manager's worst enemy. As a fund attracts more assets, its size becomes a significant constraint. A multi-billion-dollar fund simply cannot invest a meaningful amount of its capital in a small, nimble, up-and-coming company. Why? Because trying to buy a significant stake would require so many shares that their own buying pressure would dramatically drive up the stock's price. They become the whale in a small pond, unable to move without making waves. This law of large numbers effectively limits them to investing in the largest, most well-known companies. The problem is, these are the most efficient markets in the world. Stocks like Apple or Microsoft are followed by thousands of analysts, and all available public information is almost instantaneously reflected in their price. The competition here is extraordinarily fierce, and finding a durable edge or a piece of information that no one else has is nearly impossible. They are forced to compete in the most difficult arena, where the collective knowledge of the market is at its peak, further reducing their chances of consistently outperforming. The evidence against typical investor behavior is overwhelming: trying to time the market, paying high fees, trading excessively. The good news, the solution isn't complex. It's surprisingly simple. You don't need to predict the future. You don't need to find a hidden gem. You need the discipline to adopt a few common-sense habits and stick with them. These habits: minimize costs, control emotions, harness the market's power, favor low-cost index funds and ETFs that replicate the market, which start with exceptionally low fees, automate and stay the course, which smart remove emotion, invest on schedule, and don't micromanage. Maintain a long-term perspective. Investing is a marathon, not a sprint. Let's translate these habits into a clear, actionable plan that you can start today. Make a broad, low-cost index fund or total market ETF your core holding. Prefer expense ratios below 0.10%. Transition out of high-cost funds, mindful of taxes. Automate monthly contributions through thick and thin. We began with a common, deeply ingrained belief that the primary goal of investing is to beat the market. It's a seductive idea, fueled by stories of Wall Street wizards and overnight millionaires. The financial media bombards us with headlines about the next big thing. And we see charts that promise exponential growth if we just pick the right stock at the right time. This narrative suggests that with enough research, a clever strategy, or a hot tip, anyone can outsmart the collective wisdom of millions of global investors. It frames the market as a game to be won, a puzzle to be solved. But this belief, while appealing, is a siren's call. For the vast majority of investors, it leads directly down a path of high costs, gut-wrenching emotional errors, and, ironically, chronic underperformance. The very act of trying to beat the market often ensures that you won't even match it. The high costs come from frequent trading fees, the higher expense ratios of actively managed funds that promise to outperform, and the tax inefficiencies generated by constant buying and selling. The emotional errors are even more damaging. We are hardwired to feel the pain of a loss more acutely than the pleasure of a gain, a bias that causes us to sell in a panic during downturns, locking in losses. Conversely, the fear of missing out, or FOMO, compels us to buy into assets at their peak, just as the bubble is about to burst. The evidence, gathered over decades of academic research and real-world data, is overwhelmingly clear. The greatest obstacle to long-term investment success is not market volatility, but our own behavior. We trade too much, convinced we can time the market's unpredictable swings. We pay too much in fees, chasing the elusive promise of alpha from star fund managers who rarely maintain their winning streaks. We let primal emotions of fear and greed drive our most critical financial decisions. These are not external market forces acting against us. They are self-inflicted wounds, a series of unforced errors that erode our wealth over time. The solution is as powerful as it is simple: discipline. It's the conscious choice to replace speculation with a plan and emotion with a process. This begins with a dose of humility. Acknowledge your limitations. Acknowledge that you cannot predict the future, nor can the experts you see on TV. Instead of trying to be a hero, build a strategy that defends against your own worst impulses. Your investment plan should be a fortress, designed to protect your capital not just from market downturns, but from your own moments of weakness. To do this, you must shift your attention away from the noise and focus intensely on the few things you can actually control. You cannot control geopolitical events, interest rate decisions, or quarterly earnings reports, but you can control your costs, your actions, and your time horizon. The goal shifts from beating the market to simply capturing the market's return at the lowest possible cost. By doing so, you transform investing from a stressful, unpredictable gamble into a systematic, predictable plan for wealth accumulation. You align your success with the long-term growth of the global economy itself. With this foundation in place, you can let the eighth wonder of the world, compounding, do the heavy lifting over many years. It's a quiet, almost boring force, but its power is unmatched. Small, consistent returns, reinvested over decades, grow into fortunes. So, how do we put this discipline into practice? It boils down to a few simple, actionable steps. First, open a low-cost brokerage account. Look for providers known for their low fees and good reputation. Within that account, choose a broad market index fund or ETF as the core of your portfolio. This single investment gives you ownership in thousands of companies, effectively allowing you to buy the entire market in one transaction. Second, automate your discipline. Set up an automatic monthly contribution from your bank account to your brokerage account. This is the principle of paying yourself first. And it is non-negotiable. Even if the amount is small to start, the habit is what matters. This strategy, known as dollar cost averaging, removes emotion from the decision to buy. You invest the same amount, whether the market is up or down, buying more shares when prices are low and fewer when they are high. Third, review and rebalance your portfolio, but do so infrequently, no more than once a year. Rebalancing simply means trimming the assets that have grown significantly and adding to those that have lagged, bringing your portfolio back to its original target allocation. This enforces the discipline of selling high and buying low, but on a systematic, unemotional schedule. Crucially, write this simple plan down. Create a one-page document outlining your goals, your chosen funds, your contribution schedule, and your rebalancing rule. This is your investment policy statement. In moments of market panic or euphoria, when you are tempted to abandon your strategy, this document will be your anchor. It won't feel as exciting as chasing speculative tips or day trading hot stocks, but it is far more powerful, because it is built on principles that have stood the test of time. The journey to financial independence is not a sprint, it's a marathon won by endurance. Small, correct habits, repeated relentlessly over a long period of time, are what carry you to your destination. It is the automation of your savings, the annual rebalancing, and most importantly, the discipline to ignore the noise and let your plan work. Avoid the common traps, the allure of market timing, the high fees of underperforming active managers, and the concentration risk of putting all your eggs in one basket. Instead, embrace the boring, effective path. Stay calm during storms. Stay diversified across the entire global market. And above all, stay the course you have set for yourself. This is not just a strategy, it is a philosophy. It is the recognition that in the long game of investing, discipline is the ultimate competitive advantage. That is how the prudent investor wins.